All right, we are joined now by Laszlo Birinyi. He is founder of Birinyi Associates. As Lisa just told you, he also used to help run equities at the old Salomon Brothers. He also, by the way, was a strategist at Deutsche Bank. Laszlo, it's great to have you. And we also mentioned to the viewers that you used to be super bullish. Now you're just kind of bullish. It's bullish with a capital B. What do you mean by that?
Well, I think in this kind of environment, you should think more about tactics. So while I want to invest in the market and while I want to buy and sell stocks, I want to be a little more cautious. I want to be a little more prudent. And I want to recognize that there's a lot of volatility. And quite frankly, it's likely to last for a while.
How far do you think this thing can still run?
Well, we still think this is a long-term bull market. Our projection has been that it's very similar to 2000 and 1982. Those markets went on for 5 years, and I still think that this market has a lot of potential going forward.
And you give the NASDAQ or the S&P 500 or maybe the Dow the handicap. Which do you think has the ability to run the most?
I think the S&P. I'm a little concerned about NASDAQ only because there's a systemic risk of the over-the-counter market, and I think the S&P is probably the one that's going to do the best.
And talk to me about that risk in the NASDAQ market. What do you mean by that?
Well, I mean, just a systemic risk of the fact that it's a lot of dealers, it's a lot of people trading for themselves, and the fiduciary responsibilities are not quite as stringent as they were some years ago.
Do we need more regulation in this market?
Yes, I think we've gone a little bit too far in terms of new rules and changes over the last 5 or 10 years, and I think that someone should be responsible. For example, for an ETF, no one really has a responsibility to make sure that the ETF does what it's supposed to do, and I think people don't realize the tremendous tracking error that you have in some of them.
So you would probably tell our viewers to avoid ETFs and instead trade individual stocks. Is that fair to say?
I would be very cautious with ETFs. I think things like spiders and diamonds and some of the really active ETFs are fairly prudent to trade, but some of the double reversals and the oil versus S&P types, I think those are really for the professionals and the people who do it 10 hours a day.
All right, talk about professionals. There are a lot of professionals who read your research. You crunch numbers par excellence, and one of the things you point out is that we've kind of been here before. You have a roadmap. You said 1982, 1990. You overlay what we've done so far this year, and you say there's sort of a roadmap to get us to where we're going. Explain what you mean by that.
Well, markets, long bull markets, as opposed to average bull markets, tend to have 4 phases. And the second phase is the consolidation phase, which I think we've gone through. And then you have the third phase, which is sort of people accept the market. And I think we're getting into that area where more and more people realize that the market's not going to go back to where it was a year and a half ago, that this is for real. And I don't think everyone's really accepted the fact that this is a sustainable rally.
Now, there's another set of numbers you crunch. You said since 1974, there have been 6 times the market has rallied at least 14% in 3 weeks. And in each case, 6 months later, we got an average return of about 15%. Do you think that happens again?
You know, it's pretty powerful. I mean, 6 out of 6 works for me. We call these surges. And it's interesting how many historical parallels are worth looking at. And again, we wouldn't bet the ranch on it, but we keep it in the back of our mind. And the one thing I like about this market is a lot of the positive things are defensible. A lot of the negative things are not. A lot of the negative attitudes are based on I think, I wish, I hope, it should, and so on and so forth. I mean, remember just 2 months ago, people were saying that this market is going to turn soft because they thought earnings would not come through. Earnings have come through. And so I think the tangibles comes out on the side of the bulls.
Your sector timing models, and they're pretty complex, but make it simple for us. What are they telling you right now?
Well, they're telling you that we've had a pretty good rally. It's time to perhaps consolidate and digest. We would, again, at this point in the market, be a little bit hesitant. We're certainly hesitant about putting new money in. We'd be very prudent about entry points, and we'd be willing to trade. We'd be willing to take some profits and recognize that we've had a heck of a move, and no one ever went broke by taking profits.
We only have about 30 seconds, which is not fair, Laszlo, but I know some of your picks on the consumer side anyway, Amazon, MasterCard, Whole Foods, Meanwhile, on your pans, it's like GE, 3M, Goldman Sachs. Is this the consumer versus corporate America?
No, I think in this market you want to look at individual stocks based upon their individual merits, and it does not come down to themes or overviews or economic turndowns. It comes down to, again, individual bottoms-up stock picking.
All right, Laszlo Birinyi, founder of Birinyi Associates. Laszlo, always great to have you on the show. Thanks for joining us.
Thank you.